Hey everyone, let's jump right in. Welcome to today's Explainer, where we're going to do something really fascinating together. We are doing a complete, totally objective, step-by-step deconstruction of a really bold financial pitch that was recently made to investors. And the subject of this pitch? The European utility giant Iberdrola. Now, whether you follow the energy sector super closely or you're just kind of curious about how massive multi-billion-dollar infrastructure investments are packaged up and sold to Wall Street, you're going to find this incredibly insightful. We're going to break down the presenter's core arguments, objectively examine their data, and of course, take a hard look at the risks they acknowledge. Here is our roadmap for today. We'll cover the bold investment pitch, shifting to regulated networks, global diversification and growth, beyond traditional utilities, financials and future outlook, and finally, weighing the risks. Starting with Section 1, the bold investment pitch. So the presenter frames the global energy transition not just as some passing phase, but as a massive structural megatrend. And right out of the gate, they make a highly audacious claim. They argue that Iberdrola combines the stability of a bond with the earnings growth of a tech company. Now, let's pause there for a second, because utilities are traditionally known for being slow, steady, and frankly, kind of boring, right? So to suggest that this company has tech-like growth potential while somehow maintaining bond-like safety, well, that's the central paradox we really need to unpack. How exactly do they justify a claim like that? Well, the presenter justifies that bold claim by pointing straight to where the company's value actually comes from. Today, 55% of Iberdrola's value is derived directly from regulated networks, not from volatile commodity prices. According to the pitch, having this 55% majority share essentially acts as a shield. It protects the company from the wild, unpredictable price swings of fuel and power markets, giving them real pricing power, super clear visibility into future earnings, and, this is absolutely crucial right now, built-in protection against inflation. Moving right along to Section 2, shifting to regulated networks. To understand how this whole tech growth bond concept is even possible, we really have to look at a strategic pivot the company made. The pitch sets up a very stark contrast. The argument is basically abandon the old traditional utility model, the one that's heavily dependent on the weather, hypersensitive to commodity prices, and highly volatile, and move to this modern model. They are focusing heavily on transmission and distribution grids, or what the presenter creatively calls the digital highways of the energy transition. They argue that these assets are completely non-substitutable. And think about it, you literally cannot build those massive AI data centers everyone's talking about, or roll out electric vehicles, or frankly, even keep the lights on reliably at your own house without a heavy-duty modernized network. And because government regulators set the returns on these networks, the revenues are incredibly predictable and linked to inflation. To really underscore the sheer scale of this, the pitch highlights a regulated asset base, or RAB, of over 55 billion euros. That's a massive foundation. Looking at their projections for the first half of 2026, they actually plan to increase their network investments by an incredible 42%, pouring nearly 4.4 billion euros into this specific area. The presenter's argument here is pretty absolute. They assert that every single euro invested in this 55 billion euro base delivers a guaranteed multi-decade return. That right there is the bedrock of their entire investment case. All right, Section 3, global diversification and growth. Because, let's be honest, having a huge regulated asset base is one thing, but this pitch relies super heavily on where that 4.4 billion euros is actually going. Globally, they are balancing their geographic risk across highly regulated, rapidly growing markets. So, look at the United States, where they operate through their subsidiary, Avangrid. The U.S. is actually their largest market for network investment, and it's being supercharged by the Inflation Reduction Act. We're talking about a $10 billion investment pipeline over the next 5 years, specifically aimed at powering data centers and EVs. Over in the UK, through Scottish Power, they're capitalizing on the government's massive 50-gigawatt offshore wind target set for 2030. And across Europe, they've got a 274-megawatt wind project in Portugal and the 315-megawatt wind anchor offshore farm in Germany. It is a very calculated, very deliberate spread of capital across the globe. This brings us to Section 4, beyond traditional utilities. Now, to actually justify that tech company comparison we talked about earlier, the presenter knows they have to look way beyond just standard wires and poles. Enter their new economy innovation pillar. First up, they are building a large-scale green hydrogen plant in Spain with BP, which is backed by a solid 211 million euros in EU funding. Second, they are actively digitizing their networks into smart grids, using AI technology to predict demand spikes and prevent localized outages. But honestly, the absolute best detail from this entire pitch, their Agrivoltaics pilot in the Basque Country. They aren't just slapping some solar panels on the dirt and calling it a day. No, they are actually integrating fruit trees, greenhouse cultivation, and, get this, 400 sheep grazing right underneath the panels. The presenter uses this specific example to show practical, real-world problem solving for land use conflicts, aiming to lower energy costs while boosting community reliability. It's a pretty brilliant image. Let's dive into the numbers with Section 5, Financials and Future Outlook. While a compelling narrative with grazing sheep is great, an investor pitch ultimately lives or dies by the hard numbers. The core financial firepower here is a projected 21 billion euros in liquidity by the first half of 2026. To put that into perspective, the presenter argues that this massive liquidity pool allows Iberdrola to easily fund its 7 billion euro annual investment program without ever needing to go out and raise expensive equity. It is pitched to investors as a completely self-sustaining growth engine. And this investment engine results in some pretty strong projected outcomes. Analysts expect earnings per share to grow from €1.01 in 2026 to €1.08 in 2027. Based on their stock price at the time of the presentation, that puts their forward price-to-earnings ratio at just over 20 times earnings. The presenter argues this valuation is highly reasonable, especially when you factor in the guaranteed visibility of those regulated network earnings we unpacked earlier. But they really punch the whole thing home with this one standout stat: a 140% total shareholder return over the last 5 years. That is stock price appreciation plus dividends. Add to that a projected 9% annual dividend increase between 2026 and 2030 and a current forward yield of 3.5%, and you have got a very, very aggressive bull case for the stock. Which leads us to our final part, Section 6, Weighing the Risks. Now, to the presenter's credit, they do dedicate the final minutes of their pitch to acknowledging the counterarguments, which allows us to neutrally assess both sides of this coin. On one side, you've got the super aggressive bull pitch. They call it a core infrastructure holding, even quoting Barclays, who literally dubbed it the gold standard of European utilities, and they issue a strong buy rating with a €23.50 price target. But flip the coin and look at the bear case. The reality here is that the current consensus analyst rating on Wall Street is actually just a hold. A lot of financial models suggest the stock is already fairly valued at its current price of roughly €20.65, pointing to a fair price model of around €20.50. Furthermore, we can't ignore macro risks. The very regulations that guarantee their income can change if governments shift, and rising global interest rates could definitely squeeze their financing costs, despite that massive 21 billion euro liquidity pool. So, that leaves us with one final critical question to synthesize this entire pitch. In an uncertain, shifting economy, is the so-called gold standard of utilities actually worth a premium price? The presenter emphatically argues yes, pointing to guaranteed regulated growth and tech-like innovation. The broader market consensus, however, says the price is already exactly where it should be. As always, the data is laid out, the mechanics of the pitch have been fully unpacked, and the final conclusion? Well, that is entirely up to you. Thank you so much for joining me on this explainer, and keep asking the right questions.